Inheritance tax is a growing but quiet problem for more families in the UK. And I'm going to tell you everything you need to know about inheritance taxes in the UK and what you can do to protect your estate against paying 40% tax on already taxed assets. Hi, I'm Mike Pugh, and today we'll go through the ins and outs of inheritance taxes in the UK. So what is inheritance tax? Inheritance tax is a 40% tax applied after a person dies on estates that are worth more than the tax allowances. The allowance is called the nil rate band, or NRB, and the current nil rate band is £325,000 per person. In 2015 through 2020, parents that own their own home were given an additional tax relief of £175,000 per person. This is called the residential nil rate band, or RNRB, and this means that a single parent can leave £500,000 to their children tax-free. And if you're married or in a civil partnership, you could have as much as £1 million in inheritance tax relief. However, if you don't leave your home to your children, you could lose the £175,000 tax relief and only have £325,000, which is the same as about the average home price in southern England. Or, if you're fortunate enough to have an estate over £2 million, you can lose the RNRB, as it's reduced by £1 for every £2 you're above $2 million. This means that families that have estates above $2.35 million only have £650,000 of tax relief. What are the ways to pay less inheritance tax? There are several ways to pay less inheritance tax. Number one, utilize all your tax reliefs. This might seem obvious, but most people make mistakes and think the reliefs are automatic. Remember, they can be lost, so make sure you get your full tax reliefs by speaking with a professional estate planner. If the government is offering you free money, you might as well take it, because they will not blink when taking yours. Number two, make use of exemptions. Annual exemption, you can give away up to £3,000 each tax year. Small gifts exemption, gifts of up to £250 per person. Wedding and civil partnership gifts, parents can give £5,000 to their children at a wedding, grandparents up to £2,500, and everyone else £1,000. Regular gifts from income. Gifts made regularly out of surplus income are known as IHT 84 Section 21 gifts, and these are exempt from inheritance taxes. Pro tip. In effect, you can give anyone any amount of money as long as it's from surplus income. Number three, gifts and potentially exempt transfers or pets. Gifts made more than 7 years before death are usually exempt from inheritance tax, and gifts within 7 years before death are subject to the taper relief if the individual survives between 3 to 7 years after making the gift. Number four, trusts. Setting up certain types of trusts, like discretionary trusts, can help manage how and when your beneficiaries receive assets, potentially reducing or eliminating your inheritance taxes. Trusts can remove assets from the estate if structured correctly, though there are specific rules and potential charges to consider. Number five, business relief and agricultural relief. Business relief, or BR, qualifies for up to 100% relief on certain business assets if they've been owned for at least 2 years before the death. Agricultural relief, or AR, up to 100% relief on agricultural property, including farmland and buildings. Interesting to note that the new Labour government is currently reviewing AR, and it seems that the only certainty is change. 6. Charitable donations. Gifts to registered charities are exempt from inheritance tax, and if 10% or more of the estate is left to charity, the inheritance tax on the remaining estate is reduced from 40% to 36%. Number 7, life insurance policies. Taking out a life insurance policy to cover the potential IHT bill can be a very effective way to ensure beneficiaries do not have to sell assets to pay the tax. Ensure the policy is written in trust to keep it outside of your estate for inheritance tax purposes. Now, I don't sell life insurance, but I often recommend clients buy it to cover certain types of risk. For example, I had a client insure a large inheritance tax bill for 7 years that it was going to take for the taper relief to get the value out of the estate. Sadly, he died within the 7 years, but his family were very grateful for the advice to buy the life insurance and cover that specific period, as this kept the estate out of the hands of HMRC. Number 8, spouse or civil partner exemption. Transfers between spouses or civil partners are exempt from IHT, allowing the surviving partner to inherit the entire estate without any immediate tax charge. But remember, the tax man cometh on the second death. By understanding inheritance taxes and planning your estate, you can significantly increase the amount of money that you can leave to your family and loved ones. Like I always say, speak with a professional estate planner and set up an estate plan as soon as possible. Or, if you'd like to book a call, we can advise you as well. That's all for this week. Planners don't panic. I'll see you in the next one.